Welcome to SB Talks. Today is Tuesday, November 19th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be dissecting the Trump election victory, his likely policy agenda, including taxes, tariffs, and the Department of Government Efficiency. Welcome to all our listeners. We last recorded on the eve of the US election. Since then, we've had an emphatic Trump victory, a Republican trifecta as they take out the Senate and the House. Attention now turns to the Trump 2.0 policy agenda. What are your thoughts in terms of what he'll actually pursue and what he may or may not be able to get approved?
Yeah, I think probably the sort of initial priorities will be the tariffs. So the focus will be very much on that kind of in the first part of next year.
And just for the benefit of the listeners, the tariffs in terms of the ability to do that by executive orders versus going through the full legislature?
That's right, yeah. So the president has executive powers to introduce tariffs, and we've seen him use those in 2018 and 2019, so they don't necessarily have to go through Congress. So that's, I think, will be the focus in the sort of short term.
Now, plenty of risks in that strategy. I guess it depends to what degree it occurs, what degree it's rolled out. And obviously we've had some very big numbers put out there, sort of 60% hypothetical sweeping tariffs. What's your thoughts in terms of practically what might occur?
Yeah, so I think when you look at the tariffs and you look at what happened in Trump 1.0, there was a list of products from China that was drawn up. So there was list 1, 2, 3, and I think 4A and 4B. And that covered all the Chinese imports into America. And sort of 1 and 2, I think, were mainly intermediate products, so things used by businesses that were then maybe used in other products, etc. So the tariffs will probably be on those because they are less impact on the consumer. Obviously, he's been very sensitive about putting tariffs on products that affect consumer prices, particularly given that he was elected on bringing inflation and cost of living pressures down. So I can see the tariffs going on those products, the list 1 and 2, maybe on list 3. So really to take those potentially up to as much as 60%. Now, there are already tariffs on a lot of those things. The Biden administration kept a lot of them on. Yeah. So we will probably see an increase on those things. Also autos, so electric vehicles, there's already 100% tariff on Chinese imports of electric vehicles that could potentially go up. There could potentially be tariffs on Chinese-made vehicles in Mexico, so Chinese electric vehicles manufactured in Mexico. They're pretty small, and obviously European. He's sort of singled out, Mercedes-Benz and things like that, so European cars as well. So we could see increased tariffs on those sorts of products, but not necessarily the 10% across the board, which is sort of a more extreme tariff policy.
Extreme and inflationary, without a doubt. And I guess the automotive sector, if you will, is sort of the Trump voter heartland, so he's wanting to be seen to be quite protective of that. And given the successes of Chinese EV makers, they could potentially eat that alive if that came through. So there's already been very heavily protected from that. As you said, it's probably just potentially an extension and a broadening.
Yeah.
So tariffs, one of the big headline items. We've got a variety of other things at play within here. There's potential tax cuts, corporate tax cuts. We have the Department of Government Efficiency as well. The markets, before we turn to that, markets have broadly welcomed, I think, a Trump arrival in terms of equity markets in the lead-in, but the bond market, the longer-term yield curve, generally a repositioning for more inflationary threats, would you fair to say, or higher growth environment?
Yeah. So the bond market had already sold off quite a lot in the 2 months before the election, and we haven't seen huge moves since the election. So that's really been in response to a better US economic growth environment, a pivot in terms of the market's view of where the Fed takes rates down to. So sort of a couple of months ago, they were sort of thinking, rates would go down to sort of maybe the high 2s, now maybe sort of mid 3s. So really a repricing of where the neutral or terminal rate is.
And worth pausing on that and just saying that is largely because their economy continues to show quite strong health. So why would you justify cutting down to that lower neutral rate?
That's right. And we've seen Fed officials in the last few weeks sort of recognise that and think, oh, well, maybe there's no hurry to cut rates. So last week we had Jerome Powell speak at an event in Dallas. He said, does not need to be in a hurry to lower rates. So the FMC is in no hurry. The current strength of the economy allows us to approach our decisions carefully and not react to changes in Trump policy until we know we've got more certainty around timing and substance. So really sort of playing to that theme that the economy is in really good shape. We don't really need to rush to cut rates, and so that sort of plays into that view that the terminal rate is probably a little bit higher and maybe take longer to get there.
So it sort of raises the question again of why they possibly needed to start on a 50 basis point cut, but that was just the direction that they were heading in. But now we've had 25 basis points since then, and probably going to be tread quite carefully from here. And back to your favourite phrase, data dependent.
Yeah, so the market's now not fully priced for another 25 basis point cut in December or January. So we have basically one cut across those two meetings. So sort of 50-50, So the market's saying, well, maybe they could skip one of those, play into that theme that they'll be maybe a bit slower in cutting rates and more careful at the speed at which they do it.
And probably with a very close eye on what's happening on the other side in terms of Washington and the policy agenda there and the evolving picture there around inflation and growth and stimulus.
Yeah, but it's still very early days.
Yeah.
Obviously, Trump's not, he doesn't come into office until the 20th of January, so we've got a couple of meetings before then.
Albeit making some big appointments.
Yeah.
Not that we'll necessarily dive into all of those. We're talking interest rates there and tariffs. Let's talk also about, I guess, the broader, and we touched on it briefly, the U.S. debt position. And we've talked about it on the podcast before. Their interest bill now sort of exceeds their military spending, when the U.S. Military spending is a very significant portion of their budget. We've got a tax cut agenda. Can they afford it?
Short answer, no.
Yeah.
No. I mean, Trump sort of says, oh, well, all these tariffs will bring in all this revenue so that it gives us, the ability to maybe provide some tax cuts elsewhere. So there could be some fine-tuning. Certainly there were the tax cuts he brought in 2017 due to expire at the end of next year. They'll likely be extended. So they aren't additional tax cuts. There's a few little things, taxes on tips and on overtime, potentially lower corporate taxes for businesses, but they might be more targeted. So some people saying they maybe only, that would only apply to maybe domestic manufacturers, for example. So we just have to see. So I think there will be some form of additional stimulus in the form of tax cuts, but probably not that material in the scheme of things.
And you don't feel that he'd be able to necessarily roll out his tax cutting agenda to the full degree that he might have as a policy position?
No, I mean, obviously you mentioned the Department of Government Efficiency and Elon Musk and Vivek Ramaswamy charged with looking for $2 trillion worth of spending cuts in the US budget, which is a third of everything that the government spends. So that really seems quite unlikely. That
unrealistic.
They'll be able to come up with all those spending cuts, particularly when a lot of their what they spend on is, entitlement programs, which is just, that the base likes that. So they don't really want to cut those things, Medicare, Medicaid, Social Security, etc. So
it's worth highlighting this is not trying to just go into government departments and cut jobs a la Twitter or let's go get rid of that server because we don't need it anymore.
Yeah.
These are benefits that are being paid to members of the public, and therefore it's not all just fat to be trimmed.
It's not discretionary, so they're non-discretionary items. So I think it's quite difficult to see where those cuts could come through and the speed of them as well. They're talking about laying off 50,000 government workers and potentially replacing them with more conservative, more aligned workers. Well, that just takes a long time to do that. So So I think, there'll be some stimulus, and I think the market's kind of focused on that. But then the tariffs are a drag on growth, so
particularly if applied more aggressively.
Yeah, so net, it probably doesn't have much of a change on the economic outlook for the US. Maybe a little bit slower growth next year as the tariffs come in, and a little bit faster growth the following year as the tax cuts take effect.
And potentially some negative impacts for other parts of the world. You talked cars before, countries like Germany that are big industrial manufacturing exporters.
Yeah, so definitely, a lot of the research I've read says the impact on Europe and China will be more significant. So people have lowered their growth forecast for Europe by about 30 basis points next year. So, maybe from 1% or 1.1% growth down to sort of 0.8, and similar in China. Now, obviously the ECB, will react. Governments potentially react to a slower growth outlook by providing some fiscal and monetary stimulus to kind of offset that impact. And the same in China. China's obviously been stimulating quite a lot, and we've spoken about that on previous podcasts. So there'll be some offset, in terms of the reaction function from the government and central banks in those regions. But net probably slightly slower growth in those regions as a result of the trade war. Now, there's a lot of risks around that outlook, like a more extreme Trump tariff of 10% across the board.
Retaliatory tariffs.
Retaliatory tariffs, that would be very different to the sort of base case scenario I've just described.
That could be constrictive to growth globally. So as you sit here and sort of digest now, we're probably a couple of weeks on from the election and sort of taking more stock. How do you think about it from an investment allocation perspective? How does it change, if at all, your views in the world and how you would allocate?
So we actually, reasonably optimistic. So I think, the market's probably right to think that, the growth outlook in the US is probably slightly better. It was already before Trump. Trump probably doesn't change too much, maybe helps things at the margin by less regulation. Potentially we get more mergers and acquisitions activity. Potentially certain sectors get, a benefit under a Trump presidency. So it's probably slightly better outlook, particularly for the US, less so for Europe and China. So we're reasonably optimistic, and we recently changed our portfolio positioning just to dial up our exposure to US equities and to small and mid-cap companies that probably benefit more in a cyclical upswing and benefit more from some of those policies.
So you're suggesting that sort of a more buoyant economy, slightly more buoyant consumer market, that some of those cyclical type small and mid caps can benefit from, having probably been a laggard to the Mag 7 over the last few years.
So we know back in 2017 when Trump came to power, small business optimism improved a lot. There was a lot of perception that a lot of red tape would be cut, that the policies would be pro-growth and we'd see more investment and things like that. So that could play out this time around. And obviously smaller businesses are more cyclically exposed. So if the economy does a little bit better, and interest rates come down, maybe not as fast as what was originally thought, but still come down, that benefits those smaller companies as well. So,
and how much of a factor or how much of a concern point for you is it just this broader US debt position and their seeming reluctance to want to bring their deficit into line at all?
Well, I would say that's not unusual these days. We've seen that pretty much everywhere. Maybe the US is the poster child for deficits and debt.
Neither political side of the aisle wants to bring the deficit under.
Well, that's right. I mean, I think you've got things like aging populations, more spending on defence, more spending on energy transition. So pretty much everywhere that's happening. So it's hard to see budgets coming under. Being reined in really in that environment, and particularly if your interest rates are higher for longer.
Does that give you more of a pause for thought on longer term inflationary threats?
Yeah, it's something we've spoken about before, and we've thought about, potentially inflation needs to be a little bit higher in that scenario to kind of deflate some of that debt in real terms. So I think For the time being, it's fine. You know, we might get brief periods where people sort of fret about it. Like we saw a little bit of that last year, where people started
these debt ceilings.
Yeah, debt ceilings and all that sort of stuff. But for the time being, you know, the US dollar is the world's reserve currency. There's probably going to be money flowing into the US because of this better growth outlook. So it's not something that there's no shortage of people lining up to buy US Treasury bonds, you know, particularly in a higher rate environment, so high yield environment. So I think it's fine for the time being, but the day of reckoning will come at some point. We're just not sure when. Yeah.
And maybe take a quick step across domestically. Probably not a huge, but a couple of data points in the last week. Not a huge change from our outlook there, but I think a locking in confirmation that a rate cut this year is definitely not a runner, and probably not even before the next election.
Yeah, so we've had another reasonably good employment report. Unemployment's been steady at around 4.1% for about the past 6 months, so really kind of not ticking up, you know. So the RBA kind of had penciled in unemployment trending higher, and that really hasn't happened, which is good for workers, but not necessarily for you know, slowing services inflation, which they still flag as being too high. We saw wages come down from 4.1% to 3.5%, so that's good. Probably still not necessarily consistent with a 2.5% target inflation rate given where productivity is. So there's still a bit more work to do, and most economists really don't see a rate cut now until maybe February, March of, you know, first quarter of next year. But the market's probably more leaning towards May, so that would potentially be, you know, around the time or after the election. So,
and even then, given the state of the economy here, the roadmap of cuts from then is going to be a pretty modest one.
Yeah, it's quite shallow. So yeah, probably so market pricing is for just 2 cuts for the whole of 2025, you know. So some economists have a few more, sort of getting down to kind of mid to low 3s, but yeah, it's not a deep cutting cycle. And obviously, you know, rates in Australia didn't go as high as they went in other locations. We had RBA Assistant Governor Kent talk about the effective monetary policy in Australia is neither faster nor more potent than elsewhere, which basically sort of is slightly contradictory, because people thought, oh, well, you know, there's much more variable debt in Australia compared to other places, therefore the RBA didn't need to lift rates as high because, you know, monetary policy is more powerful, and he's actually saying that wasn't the case.
Well, the reality is telling a different story given how the economy's holding up.
Yeah. So that sort of suggests, rates higher for longer, and maybe not as... they don't need to be cut as much
The
either.
neutral rate will be higher than some might have hoped. So despite there are certainly pockets of stress in the economy, but broadly a cautious path ahead from the RBA.
Yeah.
An excellent summary as always, Nick. Thank you very much. We look forward to the daily Trump updates that we're getting through and seeing what comes next. We live in interesting times. Thank you, Nick. And thank you to all our listeners.
Thank you.